Welcome to the Dakota Live podcast. I am your host, Robert Morier, and we are thrilled to bring you our second episode. If you're not familiar with Dakota and their Dakota Live content, please check out dakota.com to learn more about their services. The goal of this podcast is to help you better know the people behind the decisions. We will be introducing you to chief investment officers, manager research professionals, senior sales leaders, and other important players in the industry who will help you sell in between the lines. Before we begin, I want to briefly reintroduce myself. After more than 20 years of investment sales experience, I took a step to the side of the industry to host the Dakota Live podcast. When I'm not behind the microphone, you can find me at Drexel University as a professor in the Close School of Entrepreneurship and a social entrepreneur in residence, mentoring and teaching the next generation of founders. When we developed the podcast, we said it was important to include both allocators and sales leaders from our industry to present the entire ecosystem of the investment sales cycle. And I'm very happy to introduce you to one of those sales leaders today, Zlata Gleason from Indus Capital. Hi, Zlata.
Hi, Rob. Thanks for having me. Nice to see you.
Yeah, thanks for being here. Welcome to Philadelphia.
Thank you.
It took a little while to get here.
It did, yeah.
It's because probably people are still coming out of the stadium. The Phillies won last night.
That's right, the World Series. That's right.
Yeah, and they're playing again tonight, so there's probably a good...
So I better get out of here soon.
Yeah, probably a lot of people camping.
Then
heading back. Yeah, I'd get out of here soon. Yeah. We'll get a coffee, but we'll head up. And I have a lot of questions for you, but before we get into our conversation, I want to share a bit more about your background for the audience. Zlata is a partner and the head of client advisory for Indus Capital, overseeing the firm's business development and client relations and the team supporting those efforts. Indus Capital is a $3.4 billion Asia-Pacific equities investment manager founded over 20 years ago. Indus offers hedged and long-only strategies with offices in New York, Hong Kong, Shanghai, Tokyo, and San Francisco. Indus clients include primarily endowments and foundations, as well as corporate and public pension plans, sovereign wealth funds, high net worth individuals, family offices, and financial institutions. Indus Capital's key strategies are Pan-Asia long-short, Pan-Asia long-only, global emerging markets, Japan long-only, Japan long-short, and China equities. So definitely a specialist. Yeah. Prior to rejoining Indus last year, Zlata worked in the investor relations group at Lone Pine Capital and was a director of client relations at Senator Investment Group. Zlata worked at Indus Capital as a partner and a member of the client advisory group from 2011 to 2017 and started her career at Morgan Stanley, where she worked in prime brokerage and equity derivatives departments in New York and London. Does that feel like a long time ago?
It does feel like a really long time ago.
I can imagine.
Especially after COVID, everything's so long ago. It's pre and post COVID.
Yeah, years feel like decades.
Yes.
I agree. Well, you're a CFA charter holder. You're a graduate of Wellesley College with a BA in economics and German language and literature. You're a member of the boards at Concordia Conservatory, Bosana Foundation, and Investment Community Board of City Year New York. You're fluent in 5 languages. And last but not least, you're a mother to 3 amazing children, and you and your husband live in Westchester County, New York.
That's right.
Congratulations on all
Thank
your success. How many languages are required to be a salesperson at Indus Capital?
1.
Just 1?
Just 1.
Okay,
yeah.
That's good because I wasn't sure. I was feeling. I was definitely feeling less than as I was putting together your biography. I realized why you're still at Indus Capital and I'm not. So congratulations.
We do miss you. It was really fun working with you many years ago now.
It was many years ago. I joined in 2012 Indus, and at that time, Indus was primarily hedge strategies only, so long short.
Yeah.
And you were starting to introduce long only for the first time.
That's right. You were one of the first salespeople to help us with the long only.
Yeah. And how does that mix look today relative to a decade ago?
I mean, it's predominantly long only now. I mean, of the 3.4 billion, just shy of a billion is in long short and the rest is in long only. So if you go back 7 years ago, we kind of completely switched the ratio from long short into long only. I think part of that is structural. Like if you look at equity long short assets and HFRI data, equity long short assets dedicated have halved since global financial crisis. So a lot of it went to multi-strategy funds, but a lot of it went to long only funds. And I think we were fortunate to be one of the first or early firms in Asia in particular to have long only offerings. And this was thanks to one of our large investors approaching us and saying, would you like to do this in 2009? And then another investor in 2010. But now I think a lot of our peers have kind of morphed more towards long only.
And has your sales approach changed as well now that you're predominantly long only? Do you find that there's still this differentiation between the types of audiences that you're speaking with?
So we have, as you pointed out, a lot of endowments and foundations and family offices. And in those situations, it's usually the same person we're talking to. But once we're talking to larger sovereign funds, pension plans, consultants, it is it's more like traditional long only manager research folks we have to talk to. And that's a different set of skill set. It's even different ways that you present your information. It's different databases you have to be reporting into. So I think we had to elevate our game and kind of learn a lot of that. When you were there, it was natural to you because you came from a predominantly traditional asset management firm. I think we're still borrowing a lot of your knowledge that you left from your time at Indus. But we definitely had to up our game. And I think the conversation is the same, but it's really different. As I said, like the hedge fund only pitching versus long only pitch is different. The lines have merged more and will probably continue to do so, but you can just treat them exactly the same. And I can kind of go into what I mean by that later on if you want.
Yeah, no, absolutely. Thank you. That's helpful. Well, you came back to Indus a year ago to lead the sales, client service, and marketing efforts. What were your focus areas? So you're coming back into a firm that you know well, the people, but you're starting over as a head of sales and really thinking about how to approach this market where there's a background and there's obviously a client base, but it's still a somewhat greenfield.
Yeah, definitely. It's interesting. So I came back to Indus because, I really loved the firm even during the first 6 or 7 years. I didn't really want to leave. And the reason why I ended up leaving, I just had a good opportunity to do something different and expand my horizons. To be honest, I was a little bit worried to just be sitting at an Asian firm from my career perspective. So I feel very grateful that I've gone to a hedge fund that did event-driven equities and credit, and then a global growth manager where I learned a lot of other things. So coming back to Indus, I felt like I had just much better perspectives, how we need to do things and what we have that's really special about our firm. When I walked into Indus, literally the first 3 months, I was actually on sort of leave because it was summertime. So I had 3 months in between jobs. And I actually ended up spending a lot of time with my family, but also sitting down and listening to everybody at Indus what they wanted to accomplish. And I think as a salesperson, it's really important to listen, not just to your investors, but to people internally. And then I basically went off and wrote a business plan. And I was like, okay, this is what I think they want to do and what I think we could do. And there are areas where the firm wanted to accomplish things. And I was like, I don't think, maybe eventually, but not now. And after I wrote the business plan, then I was like, do I have the right people here? So I really went around and kind of tried to understand the skill set of the team that was there. And what was really apparent to me is that we needed to elevate our game, both on the client servicing side, but also bring in folks who had more approach to knowing how to talk about long only or knowing how to go into international markets where we traditionally have really done not so much, even though what we do is all outside of the United States in terms of investing. So those are some of the priorities. And then what's interesting when you go to a firm that's been around for 22 years and you're like the old yet the new person, because they've changed and I've changed in the 5 years that I wasn't there. You have to be respectful of the context and the history, but you also were brought in with the mission to change things and evolve because there was a need while you were there. Now they obviously were missing something, and that's why they're bringing these people back. So for me, it's been an interesting first year. I always have to remind myself I'm old here, but I'm new and I have fresh perspectives. I think it's really important when you're within an established construct to be respectful of the history and all the people who came before you, but you have to acknowledge that there's something that is not working as well, or the market has changed and you have to evolve. So that constant pushing the brakes on, pushing the pedal, pushing the, push and pull, that's been probably the hardest thing of honestly coming back and trying to take this on. The other thing as head of sales, when you're just a salesperson, you have your list, your territory, your responsibilities, you're kind of just doing stuff, getting out there, executing. I feel like now I'm a bit of doing still a lot of that, but also coaching and delegating to the others. So being kind of player coach has been just a good learning dynamic as well for me, because I didn't really do a whole lot of that in early 10 years of my career.
How do you find that your time is allocated between the two? If you have to think about,
it really depends on what's going on in the markets. This year I've been spending a lot of time definitely proactively getting our story out there, talking to existing clients, because it's been a tough market environment, and just explaining what's happening with the portfolios. So I would probably say those are 70% of my time, and I will bring my colleagues along for a lot of those conversations, and we'll do trips together, we'll cover clients together, and then the rest is the strategic piece. I do a lot of strategy thinking, are our fees competitive? What are we doing on ESG front? Should we be doing a podcast? All these other branding strategic things that I have to worry about.
Hopefully you being on here will at least alleviate that for a little while.
Yeah, exactly.
So you can see how it actually works.
Exactly. We checked that box.
But something big did happen over those 5 years. There was a fairly significant succession planning event. So
yes.
I know, one of the things that we get asked quite often on the institutional sales side is what is the succession plan, and what if there were a change in ownership, what would that look like? And you went through that at Indus Capital and kind of inherited those changes. Maybe some of them were even still happening a little bit.
Yeah.
But I think for our audience, that would be something interesting to learn about. Like, how did you telegraph that to your clients? How was it communicated? And then how was it received?
All the firms I've ever worked on buy side, I was either there or shortly thereafter they went through their succession plan. So I feel like you know the drill. I feel like I've seen different versions of the story. I think what's really important, and what Indus in particular did well, from the very beginning, the two original founders really stocked the talent pond with a lot of talented folks who they would look at and say, well, that person could have my job one day, and I want to empower them and incentivize them. And they've given a lot of economics in the business from day one to be able to achieve that. So when we started transitioning, actually, the first transition did occur on one of our funds in 2012. And I was there for that. I think what it's really important, and having seen this at Indus and other firms, is to telegraph this well in advance of succession happening. When I was on sell side, I covered some funds. One of them is really well known, who just one day decided to make a plan and appoint somebody else, and their clients absolutely were not responding to this in a positive way because they did not know much about this person. They knew that he was there, but that was kind of the extent of it. So I think if you're going to go through succession, which a lot of firms in our industry don't do as well. I think long-only asset management firms do a good job. Private equity firms do a really good job. Traditional boutique hedge funds don't end up doing a really good job. And more often than not, the firms fold when that personality or the name of the door decides to do something else. What I think the firms have to do, and what we have to do as salespeople and investor relations people, is to be really honest that these transitions are just natural evolution. It's nothing that you should be ashamed of or hide. This is passage of life, passage of time. And eventually everybody's day will come to pass the baton. And I feel like my day will come at some point too. And when the day comes, I want to be very upfront with our team and our investors that this is what's going to happen. So I think honesty, transparency, not hiding this, I think that's the worst thing you can do. And then just being thoughtful also about economics. You don't want this event to tank your company down. You want to be thoughtful how you transition this equity, and you want to use these events to look at the next generation of leaders and say, this is really good for you because you are now going to be able to get more economics and more skin in the game. And this is the playbook when your time comes. Now we know how to do this. And at Indus, it was really interesting. We have, I think 75% of our analytical team is new in the last 5 years. So I'm meeting a lot of new people, Rob, that, I did not know first time around in Indus, and kind of getting to know them for the first time. And that generation is really excited right now because they can see next 10 years, Indus is going to have, again, transition. Again, this is not a secret, just it's passage of time and people moving on. But now they're comfortable. This is one firm that knows how to do that. But look, it's not, now that it's behind us, it's kind of easy to talk about it. When we were going through it, it wasn't super easy. But, I think there's a playbook now, and I think you just have to be really thoughtful and really honest and be transparent with your investors. And I'm sure we'll talk about this later, but one of the things that I really pay a lot of attention to is you have to be cognizant of this transparency and respect for your investors, because at the end of the day, you are a fiduciary for their capital, and you owe it to them to let them know what's going on in your organization.
Yeah, absolutely. And they're consultants as well. So
exactly.
They're not operating alone.
Exactly.
So there are different points of
multiple players in a relationship that you have to keep in mind. Yeah.
Yeah. As you built out the team, did you think about dedicated consultant relations or dedicated, hedge fund investor relations, relationship managers?
I did. And to be honest, I kind of, we're a $3.5 billion firm, so we're not a huge team. It's basically 5 of us, plus we have an executive assistant. So it's a team of 6. And I wanted to find a multi-skilled athletes who could talk to endowments and also talk to consultants. Maybe into the future, it would make sense to have somebody just dedicated for consultants. Right now, I have switched my mindset to have more of a generalist model. And this actually applies to everybody in our team. as much as they do sales, they also do some investor relations, and they are able to also client service somebody who's looking for their capital statements or is trying to understand where the offering materials are housed. So I'm more of that mindset right now. It could be just a function of being at a more boutique firm and having limited resources to deal with. But consultants are incredibly important, and I've seen a lot of value having a dedicated person. So maybe that's something just to rethink in the future.
Yeah, I think it's interesting. When I joined Indus in 2012, there were 5 or 6 consultants that essentially dominated the alternatives landscape. So that has grown quite a bit. So I would assume not only are you, working maybe with less people, but you're also dealing with more consultant relationships and particularly outsourced CIO relationships.
Correct, yes.
That continue to grow and proliferate in the industry.
Yeah, so we have been part of this business plan that was put in place about a year ago does include dedication to OCIOs and consultants. But so I totally agree with you. Like I think consultants and OCIOs have sort of become a whole lot closer, and a lot of consulting firms, traditional ones that we used to talk to now, have big growing OCIO businesses, and that's a different person you need to be talking to. Yes, a lot of that we are focused on, but it's kind of split across the team.
Well, you are a specialist in Asia, so that's another interesting dynamic to what you all have to do. So I would assume there's an education component, because you are essentially trying to convince, I would assume in some cases, and correct me if I'm wrong, that an investor may not have a dedicated exposure to Japan or may not have a dedicated exposure to China. How is that added to all of what you're already doing? No,
definitely. There's a lot of education that goes on, and it is a more sophisticated conversation in a sense, because you need to know a lot more about these markets to be able to explain it to somebody who doesn't know enough about those markets, and they're looking at you as the specialist, and that's like a huge responsibility. Like, oh gosh, we're Asia specialists, I better know and act like a specialist and tell them, all about this wonderful part of the world. So there is a lot of education. I think the challenge for us and my team is, at what point do you stop educating and kind of ask for the order? Because education works both ways. Like, you also don't want to be like a research post, just, giving them a bunch of content and there's just so it's like this delicate balance, educating, but also realizing you have limited amount of time and you have other clients to talk to and cover. We try to do a lot of these webinars now, like more kind of thematic calls, which is a new thing at Indus, where, last year we hosted something on China and was really specific about regulatory issues and what was going on with the education sector and some of the crackdowns that were really well documented in the press. But we want to give our perspective from different portfolio managers. A few months ago, we hosted conversation about the yen and the BOJ policy. We included our macroeconomic consultant into that conversation. This was really well received. I was in San Francisco a few weeks ago, and we had a former policymaker who worked for the U.S. administration talk to a handful of our clients about what's going on. And this was literally as the Congress was unfolding, what his read was on the party Congress and what the implications might be for investors in China as well as Taiwan and potential military conflict there. So we tried to do now a lot of those sessions where we're showcasing and helping educate investors. And it does go a long way, to your point, because a lot of investors don't have deep boots on the ground to understand what's going on. I think, I was an econ major, so to me, it's really fascinating to talk about the yen weakness and some of these currencies and current accounts. Like, this is what I did at Wellesley for 4 years. And I, look to our team, and I'm sure this will come up, like, do you have a product specialist, which we don't have on our team. We used to have somebody as a product specialist. I think, again, there's a function of our size here. Like, if we were $100 billion asset management firm, I could see why we may want to be hiring a lot of product specialists. But right now we are, like, you're looking at product specialist. I am the marketer and the client service person and a product specialist.
I should have listed that off. Exactly. I figured that might be the case.
Yeah, you need to be, yes.
But that begs a lot of questions about, because as you know very well, whether you're an Asia specialist or you're a global equity, long only manager, it's still all about fit. So how does this strategy fit into your asset allocation model?
That's right.
So as you think about your clients, you and alternative managers in general historically have had predominantly endowment and foundation, high net worth, family offices. So as you've expanded outside of those channels, how has that conversation around fit changed, if at all, or is it still the same message I'm just curious, just because diversifying outside of kind of your core channels is something a lot of our audience think about.
Yeah. No, definitely. I mean, you definitely have to so there's my view, and then there's kind of what I feel like industry has gone to. So my view is that regardless whether you're an endowment or a family office or a public pension, if you're looking at Asia, hopefully you're finding the best, most tenured, reputable firm to partner with. And I know sometimes it's like, okay, what's your vol like? What's your Sharpe ratio? What's your information ratio? There are some metrics that will screen you in or out of the process. But overarching, hopefully, like those metrics are just the next kind of level once you figure out, I want to find the best Asia manager in this space, in equity space, and talk to them. Now, having said that, we have evolved when we started going after public and corporate pensions in a sense of, our fees came under scrutiny, willingness to take managed accounts, willingness to give transparency, willingness to get into side letters. Those became things you had to do, which in early years of Indus, nobody really asked us, so that's why we didn't do them. So that kind of fitness for their portfolio has evolved. But I think and the other thing is like consultants. Consultants are a lot more important gatekeepers of some of these larger institutions. So we had to evolve, to my earlier comments about that, knowing how to talk to them, who they are, how to keep them up to date. The other thing with consultants is like you have the research teams, and then you have client consultants, and sometimes in some organizations, you have to talk to those different layers as well and keep them up to date. So, this kind of goes back to the earlier point. How do you do all of this effectively? And I think, again, you have to kind of pick your spots. So the fit for the portfolio, what I tend to do a lot of is you have to be prepared in this business and do your research. The good news about public entities is it's in the public domain. You go through their reports. You can even see who their consultant is. You can read the meeting notes. You can see exactly what was discussed, who was recommended, who was terminated. You can go through investments, see their holdings. Actually, on a long-only side, your life is a little bit easier because you can get a lot more information publicly available. With hedge funds, it's not
still
the
a little
case.
Black box.
It's still a little black box.
Even the allocators still treated a little bit black box.
Even the allocators, and some allocators will be friendlier and tell you what they own, and some others will not. And then you'll have a lot of friends at the firms. You'll kind of pick up mosaic theory of where these folks have money. But I think it's really important to ask, again, going back to listen and ask questions. And I think our profession sometimes does a mistake because we want to accomplish a lot. We want to get through a lot of meetings, a lot of content. I've done this myself. You just show up to a meeting, you're so excited to tell them your story about your firm. And then at the end, that person asks you one question, you're like, oh, this is just not going to work.
Yeah.
So I think to understand this fit, you have to do a lot of research. You have to ask a lot of questions, and you have to have a confidence to say, you know what, you're right. This is never going to work. Your just requirements and your fit criteria are so different than ours. But I know a firm over here that's a lot more similar to what you're looking for. Let me make the introduction. And I do that all the time. So I did capital introductions in my past, and I still help my peers get introductions because that's the right thing to do. And I think sometimes I'll be the one to say to the investor, this is not a right fit. Like, this partnership is not going to work. So let's, this was a great introduction, but let's,
I think that's great. And it makes a lot of sense, especially as a specialist.
Yeah.
Sometimes it's just not going to fit. But you said the other F word.
Yes.
Fees. Another four-letter F word.
Yeah.
So that's, again, just looking back at alternatives firms reputationally, as they were going into long only, they were price pointing a bit higher, getting a little bit closer to what they were charging, previously. How have you seen that evolution? And as you're thinking about those conversations with potential investors in the long only space, how has fees
played into that?
Yeah. Exactly.
So, fees have definitely been in structural decline. I think there's so many ways to prove that point. We've definitely seen pressure on fees in our long-only funds. Having said that, because we are specialists, and for example, in Japan, there's not a lot of long-standing Japan managers with 22-year track record. So you could still get premium fees because there is a bit of a premium to get into Japan in a dedicated fashion with somebody who's been doing it for a long time. But we have in other, and it's very market specific. Like, some markets are a lot more worried about liquidity, ability to get out if something goes wrong, and the fees. And then there are some types of investors that are just not as sensitive about that. So I think you have to kind of define what is your TAM, like what's your addressable market you're trying to go after, and then also be honest with your colleagues internally. So, when P&I has a big article that somebody landed $500 million from a large pension, and that it was for very low fees that your firm would never agree to.
You put that on their chair.
You need to exactly say, yes, they did win this mandate, but it was the economics that we agreed we wouldn't do. So I think there's just got to be expectations. Where are we willing to price our fees? And are we competitive right now? We're actually going through this study at Indus, and I haven't done this yet since being back, but like holistically looking at our funds and saying, are we priced competitively for what we have to offer, for what our alpha is, and how are we compared to our peers? And then get input from our consultants and clients who probably will say, like, it is expensive, like cut your fees, but just to kind of get more thoughtful sense of where we are. And then we're going to go to the senior management and have the debate, like, do we want to reduce our fees? Do we want to just say, okay, now our addressable market is going to be a fraction of what we thought it would be because we're only going to be this premium, higher priced manager? And that's fine too. So I think as long as like we all agree what we're delivering on, like I think it's fine. But look, the fees have absolutely come down. In our hedge fund, we never were 2 and 20. From the beginning in 2000, our hedge funds were priced at 1.5 and 20. And about 6 years ago, this was just happening as I was leaving, we did work with some of the larger consultants, like Allborns of the world, to be more aligned in our hedge fund fee structure. So we had to change, and I just think you have to be open-minded and commercial.
Did that change come from the clients, consultants, and the manager, or a combination of all three?
I think it was a combination of all three. I think there's a danger of racing to the bottom and always changing your fees when an investor asks you, because that's like an endless, bottomless pit, and you can constantly renegotiate your fees all the time if you do that.
And have a lot of side letters. A
lot of side letters, which that's been one of my priorities, is to, unless it's for a specific regulatory reason, is to not agree and enter any side letters. Because if 3 clients are asking you for something, then maybe we should be changing our offering documents. Maybe the market is telling us this is a provision that everybody should be getting. So I think on fees, we try to, and again, this is kind of the 20% of my job, is like, when not calling clients and not, raising capital, is like innovating and thinking what's ahead, what's next, how can we be proactive? And this study on fees is to be proactive, to just say, okay, let's just assume fees are going to continue to decline. We don't have to be a first mover in this, but we want to be thoughtful, and at least every once in a while, once a year, just do the work to understand where we're being priced. And the portfolio managers, and now we have a CEO too, who's very involved in everything that's not investment related. Like, they're pretty good about being proactive and saying, don't do something because you have to. Because usually, like, if you've had a bad performance, your clients are asking you for fee reductions, it's almost like too late. Yeah. You should be doing these things proactively when the firm is having a good period of performance. So you do have to be proactive.
And is capacity and discussions around capacity in that conversation as well? How does that work, particularly when you're in a market that's arguably much less liquid? Yes.
Capacity for sure is a topic of discussion constantly. So our risk team usually run liquidity metrics and say, okay, if you were to increase your AUM by this much, this is what it would do to the liquidity profile of your portfolio. And so when we tell somebody, we only want to raise X amount of dollars, it's usually backed up by the data from the trading and the risk. It's not this made up number. We had closed our funds to new capital historically. So Indus does have a precedent of saying we're, hard close or soft close, only replacing redemptions. We're not there now. I feel like in this environment, everybody's looking to take capital, not because, people are having redemptions left and right, but it's a really good opportunity to get into these stocks at these levels. So right now we're not capacity constrained, but I would imagine one day into the future, like we will be, and this is similar to succession planning. You have to telegraph this to your clients. The worst thing that would happen is you're working with some of these 2-3 year long mandates, and they're just ready to write you a check, and then you're like, oops, sorry, there's no capacity for you. So we never want to be in that position.
Yeah, no, that makes sense. Well, taking a step back, so you have been there a year.
Yep.
So as you're thinking about your sales process, so we're in Philadelphia at Dakota Studios. studios. And as you look at a market like Philadelphia or any metro area, what does the sales process look like for you now that you've got the boat's not rocking quite as much?
Yes. What's really interesting, this is my observation, but after COVID, it's harder to get meetings with people in person. It's obvious, not just like early on when people are worried about contracting the virus, but they're like, if I can do Zoom, I'm not going to travel. I'm not going to ask you to come and travel. This is like a lot more efficient. But when you get the meetings, I feel like they are meeting you because they genuinely want to engage with you. So like, I almost feel like COVID has helped separate the true meetings versus just kind of fillers, informational.
Yeah, that's a good point.
So I think that has impacted our approach and kind of saved us time. Look, I think Philly is a great market. There's some really amazing investors here. It's so easy for us to get to. So I typically come down to Philadelphia, probably once a quarter, not more frequently. We're having some active conversations with folks here. So to the extent those become clients, I probably would come even, more frequently. But again, a lot of Philadelphia investors go to New York. Like it's really easy. I kind of think of it geographically. I think Texas is a really important market for us and always has been. So we really try to go to Texas very frequently as well, at least, once a quarter. We have decent amount of relationship in Chicago area. West Coast, we have an office, San Francisco office, so that's easier for us because when you go to the office there, you can usually do a lot of meetings. And then, I-95, as we used to joke, like it's so easy, right?
Yeah,
like you
corridor.
And I were like the corridor, I-95 corridor. So all those, big cities are, Boston, DC, those are all great markets for what we do. And we get there a lot. I've been spending a lot of time internationally, so we can talk about that too. Like I feel like our firm is not as well understood or covered in some of these international markets. So I've been spending a lot of my time on Australia, less so in Middle East, but ramping up those efforts as well. And then I was just recently in Singapore and really had some fascinating conversations with people on the ground there. And that's a whole different level of conversation. Some of these investors are for the first time hiring dedicated equity long short managers. This is like United States in the 90s and 2000s.
Yeah, especially in some of the markets that you mentioned. So that's interesting. I mean, overseas distribution is something a lot of, not just boutiques, but boutiques growing into mid-sized managers or mid-sized managers graduating into someone a bit larger.
Yeah.
They're thinking about overseas distribution for the first time. And in my experience, the way that conversation usually starts is a reverse inquiry.
Yes.
So you get a call from someone in the UK, you get a call from somebody in the Middle East, you get a call from a super in Australia.
Yeah.
And all of a sudden you need an overseas distribution plan. Or
a licensing rep or, all sorts of jurisdictional.
The right vehicles.
That's right.
Do you have what do you have what it takes to be able to distribute effectively into these markets?
Yeah.
And then there's this steep learning curve that comes along with it. Yeah. So I guess maybe taking a step back. So why do you think, I know sometimes things can come faster in certain markets. So it sounds like in the United States in particular, Indus saw a lot of success earlier on and has carried that through over the last 22 years. Yeah. So where are you going to start?
I know, it's a big world out there.
I mean, you mentioned some of those countries are pretty far away.
Yes, they are. No, and it does involve a lot of travel. And you have to be sensitive about the budget too and the time it's going to take for you to raise money in these markets. So I tend to think of, and when I wrote my business plan, it's diversity of conversations and diversifications and also diversification of timelines. To raise money from some of these other regions, it is going to take you a couple of years. So your whole overseas or distribution strategy cannot just be one of these markets, right? Because you'll sit there for 3 years, waiting for that ticket to come. So you have to have some short, medium term, try to understand who's allocating now, who's a good prospect to, have over time. I didn't include Canada. That's an overseas market. It's an hour flight from New York. We actually have done a lot in Canada. I find Canadian, Australian market to be really interesting because they actually do understand the value of Asia specialist and also a country fund. A lot of conversations in the US, they may want to hire a Pan Asia manager, but the country fund is just really out there for them. I found in Australia and Canada, they do want country specialists. So they go even a level deeper. And those conversations for us, going back to the fit, I think our firm is a much better fit in these markets, which does accelerate some of these conversations. Most recently, like a lot of these markets are looking at what's happening in China and saying, how do we address this? Do we want to have a China dedicated allocation? Do we want to do something else in Asia? Like those are great articles. When I see those, like I get super excited because I know I can just call them and immediately I know what we're going to talk about. And where do you start? I mean, you're right. Like sometimes it is somebody gives you a call and the next thing you know, like you've spent 6 months looking at the region, then you're on a plane. Right now, our focus is really Singapore for the most part, because a lot of family offices have moved there in the last 3 years. Singapore has actually become a huge wealth management hub. A lot of sell-side banks are now putting bigger wealth management groups on the ground in Singapore. And I think people, as they got out of Hong Kong during the lockdowns, I don't think they're all going to go back to Hong Kong. Like, I think those trends are going to be harder to reverse. I'm really bullish in Singapore. I think Australia is fascinating. To me, it's a huge market.
Lots of consolidation.
A lot of consolidation going on, but it's a superannuation market where your compulsory contributions that these plans make on your behalf grow at a pretty steady rate. So it's a pretty steady business. And they are some of the smartest investors, I think, that I've dealt with. Same with Canada. So that's where we're starting. Those are the 3 locations.
That's interesting, and that's a little different than what you normally hear. I think the typical answer is London. And, start in London, see what you can get, and then go up into the Nordics, particularly with public equities. Yeah. And then if there's a little bit of interest, you go down into the continent. And then from there, maybe you move into the Middle East if you can get a couple of meetings with some sovereign wealth funds.
Yeah.
So it sounds like it's a more satellite, almost more peripheral
It
approach.
is more peripheral. And I should mention one of my colleagues, like she has done a really good job in Europe. We used to have a London office. We don't have a London office anymore. And we used to have UCITS funds back in the day. We don't have UCITS funds anymore. So Europe is important to us. I think about 15% of our capital is from Europe. So it's still a really important market for us. But I think of it more of like kind of where the brand new markets that Indus hasn't really done a good job. I would say like Singapore, Australia, and Canada.
That's interesting.
Oh.
Well, you mentioned ESG. There's a lot of ESG interest in those markets as well, particularly Australia and Canada.
Yes.
Not just interest from an investment perspective, but interest from a legal perspective. Laws are being implemented that are changing the approach of asset managers into those markets.
Definitely.
Whether it's a policy on modern slavery or zero admissions by a certain
or child labor, in some of these markets, and human rights violations.
Yeah, and not to pick on the Asian markets, but it's historically there's been more negative press, negative headlines coming out of those markets from an ESG perspective. So
Definitely.
How do you think about that as your, I guess I should ask it this way. Do you integrate ESG into your investment process?
Sure. We do. So we are not a ESG fund. We don't have an ESG share class. We don't have an ESG fund. We don't use screens and say we're just going to ignore these stocks. We have few clients who have managed accounts with us who have lists, exclusionary lists that say you cannot be investing in this. And those are easy conversations because most of these companies we wouldn't invest in anyways from the fundamental research standpoint. And because it's a managed account, we have an investment management agreement. Of course, we're going to take those stocks out of those portfolios. So the way that we integrate, so a couple of things have happened. I think you made a really interesting point, which is an important one, because in Asia, for the most part, transparency on ESG issues is not as good as in developed world. Europeans are way ahead of the US, by the way. They've been onto the...
And even Japan. Japan has never been the most transparent market, so it's been a little bit challenging. Korea is another good example.
Correct. So I feel like our job is even more important as shareholders in these companies. As SEC registered, US, half of our team is in the United States, most 70% of our capital is in North America. Like, we even have greater responsibility to ask these tough questions when we go to the meetings. Japan is an interesting, I'll get to that in a second. Japan has changed a lot, and GPIF had a lot to do with also pushing Japanese corporates on certain, definitely corporate governance issues, but on environmental issues too. Like, if you think about Japan, they're thinking about bringing nuclear energy back right now. So that's like a really big effort. So I think, when you go to Japan too, like, they've been way ahead of lights that are efficient, like not using a lot of plasticware. So I think on the E stuff, like Japan as a society have been actually ahead of us. I think on the S, there's probably some work to do, especially with companies that are run still by the original founder, kind of more small and mid caps in Japan. But just overall in Asia, so what we do, so we have, each fund and at the firm, we have our statement policies. This is what we stand for. These are the things that we'll typically avoid. And, we typically shy away from extractive industries. We definitely, there's like human rights violation in some of these companies, as I said, child labor. There are certain things that are no, and like those companies will not end up in our portfolio. We have an ESG committee that's comprised of research, portfolio management team, compliance, operations, trading, and I sit on that committee as well. We meet quarterly, and our job is to talk about how do we integrate these issues across the firm and also within the research. And our head of research is on that committee as well. And what the analysts do, so within our research database, there are qualitative fields they have to fill out for each of their companies on E, S, and G. What are the most pressing issues? Are you doing anything about these issues? And I'll give you like some examples on where we've corrected some of these issues, because it's great to say we integrate this, but then what are you doing with that information? Are you just telling your clients to get some brownie points or raise money, which is not what you should be doing?
Or checking the box.
Or are you then going back to the company and saying, we have an issue with your stance here and we want you to make a change? And we are a significant shareholder, so hopefully you'll listen to us. And we've done that in few situations. And there was one very recently that I'll get to in a second. And then so that's the qualitative aspect, how analysts need to monitor these issues and document them. And then we did run our portfolios through Bloomberg S&P Global Rating to see, low, medium, high, and mocked up these investor reports and shared them with some of our larger consultants. And we had a lot of calls where we said, is this useful to you? Do your other managers provide this? And the feedback we've gotten is actually not a lot of people provide this. And I don't know what 94 score for this company even means. Like, what is this? So now what we're trying to do is to say, and this is a very active conversation, do we develop our internal quantitative scores, like a scorecard, call it 0 to 5, where analysts who know these industries better than these rating agencies would give them the scoring, and then we'll track that score over time to see progress or not progress. And then that will be kind of a more quantitative measure of these qualitative issues. So there's one example. There's a China-listed company. It's a port operator. We noticed they didn't have a woman on their board for the last 4 years. And the research team really thought that, like, that's kind of not okay. Like, you're really large, one of the largest port operators. To have no diversity of opinions, no female representation in your company for 4 years is a little odd. So we wrote a letter to them, and actually they just recently appointed a woman. And it wasn't, I'm not taking credit, it was just because of our work. I think a lot of their other shareholders felt the same way. But that's an example of ESG integration. Like, there was an issue, we were vocal about it, and we didn't stop until we got a response from the company. And thankfully their response was, yes, we just actually nominated somebody. And I hope they nominate more women. It shouldn't just be a woman, it should be multiple. So that's kind of an example of what we do. But ESG is a big debate. And one last thing, we get a lot of questionnaires from different consultants and investors. ESG specific questionnaires. So what we're trying to do as well is look at the common denominator across these questions and say, why don't we, instead of answering 5 different organizations, just implement this into our standard DDQ? So we're now in our own DDQ have sections dedicated to ESG, DEI, and we also use ILPA and AMA, all-born DDQs as the templates for what those questions should look like.
Well, you mentioned DEI. I remember I think at one point you were the only female partner at Indus Capital, and prior to you, I don't think there were any women in the partnership. But I think I saw in your presentation there are now 9 partners and principals.
Yes.
So it sounds like there have been a lot of strives in terms of DEI and balancing the.
There's been a lot of progress made, which is good. I think our industry was due for some course correction on, racial, gender representation and having more senior women and men of, different backgrounds in those leadership positions. So Indus has done a good job. Yes, I was the lone female partner, and now we have a principal program. So we have 12 principals or thereabout who actually share into the economics of the business as well. So between our 12 partners and 12 principals, 24 people are actually tied to the economics and have skin in the game of the business, which is also a great development. And I just think does a lot for your culture and motivations. So I think Indus has done a really good job. We have kind of a women network as well internally. One of our partners, she's a member of the Chief, which is this really exclusive network for successful women. We've done a good job, but we can't stop. You know, I feel like we sort of, well, I personally, this is my view, but I worry that women in our industry have come really far, and then COVID happened, and then kind of we've gone back a little bit. Because if you look at the studies, and I know this is not the case with you, because you know you're so involved with your children, but like for the most part during COVID, a lot of the household chores and work fell back on women, and now like female participation in America has actually gone back a little bit. So I'm a little like sad about that, to see that COVID set us back, but I'm really positive. In my profession, there are a lot of senior women, you know, and endowments and foundations, family offices. Even now, like in California, like some of our larger public plans have women CEOs. So I'm rooting that we can, you know, do better and get to equality over time.
That's wonderful. Well, we are too. And we're so happy you joined us today.
Yeah, thank you so much. This is really fun. Good luck with your
Thank you.
venture, and it's good to see you.
Yeah, it's good to see you too. Well, if you want to hear this episode or any of our past episodes, you can check us out on our website at dakota.com. We are now up on all of the major podcast platforms, so Spotify, Apple, and more. You can also see this video on YouTube.
Great.
So feel free to check us out. And if you'd like to learn more about Zlata and Indus Capital, please check out their website, induscap.com. Okay, great.
Thanks so much, Rob.
Well, thank you, Zlata. This was great.
Thanks for having me.
Okay,
Don't
thanks.
say
Bye.
good.